Buying your first investment property should feel exciting, right? You've worked hard to get there. It's an achievement. You should be feeling proud. But instead, I see many people end up feeling uncertain, scared, or worse, they end up regretting their investment down the line. And all of that unnecessary stress could have been avoided if they just understood the simple, proven, time-tested strategies that the best investors in Australia use. Look, I've been investing in property now for 23 years, and over the last 9 years, I've helped over 500 investors invest successfully in property to grow their wealth. So today, I'm going to share with you the most common mistakes I see so many investors make, how you can avoid them, and my proven roadmap for investing successfully and safely. Let's begin by looking at the most common myths I see so many investors fall for. Number one, all property in Australia rises in value, so it doesn't matter what you buy, you're still going to make money. Look, if someone tells you that, here's my advice: run, because they're either blindly naive or they're just trying to flog you something. The truth is, property in Australia all performs differently depending on a number of key fundamentals. So you can't just buy blindly and expect to make money. Number two, you should buy as many properties as you possibly can, because having more properties makes you wealthier. I've seen so many people fall for this trap. They get told that they should be buying lots of cheaper properties in small country towns and locations with very little economic fundamentals, and they get burnt badly. Number three, investing in property is great for tax benefits. Look, it might be, but if that is your major goal, as you'll see in just a moment, it can lead you to making some horrible investing decisions. And I saw someone make virtually all these mistakes. It was someone actually who I'd known for many, many years, someone who's very close to me. And when I saw the advice that they received, that was one of the major motivating factors for me to actually start doing what I do today. They were a couple who were quite time poor. They were earning okay income, but they really wanted to build wealth for retirement. And they got sold the dream of, you're paying too much tax, so you need to focus on buying property for tax benefits. Oh, but then you also need to focus on positive cash flow to start off with, because after all, if you want to retire, if you want a passive income, then it's going to be positive cash flow that gives that to you. So you need to focus on getting positive cash flow from day one. And then they were told, look, you need to get as many properties as you can, as quickly as you can, because buying these properties will help you grow your wealth. And rather than buying a few really good quality properties, buy as many cheaper properties as you can. Now, this couple ended up following this so-called advisor's advice. They ended up buying 8 properties in a short amount of time, really leveraging hard, being as aggressive as possible. But you know what happened? Yes, they got their tax benefits okay. But when they then came to sell 7 years later to see if they could release some funds for retirement and paying down their personal mortgage and everything else, they found that of their properties, except for maybe 2, all of them were worth less than they paid for them. Worse, throughout the investing journey, sure, there had been times when they had got positive cash flow, but there'd been other times when they'd struggled to get a tenant. Some of their properties had gone many months between one tenant and the next. So that positive cash flow, that evaporated, and they found themselves having to work harder and harder just to pay the interest on their multiple mortgages. When I spoke to them recently, they said that if interest rates had risen as sharply as they did in the last 2 years, it would have totally crushed them. They would have probably had to declare bankruptcy. So I've seen people being sold these so-called dreams, and they end up being a complete nightmare. It ends up draining people's finances rather than actually growing them. So don't let that happen to you. Instead, focus on what builds true property investing success, which is having clear goals, a proven plan, an understanding of your risk profile, and focusing on quality assets that each build on each other to reach your property investing goals. Now, how do you do that? Well, first of all, you need to be clear on what you're trying to achieve. That might seem obvious, but as I said before, I see a lot of people investing in property just because they want the tax benefits because their accountant said you're paying too much tax, or they're just investing out of greed, but they don't actually have a clear goal. Like they want to invest for retirement. They're looking to invest so they can help their kids in 10 years' time. Something that's very, very tangible. So that's your first step. Second, get clear on your risk tolerance. Right now around Australia, different areas are growing. However, there are different risks associated with those areas, and you need to be clear that you're aware of those risks and you're okay taking those risks in certain areas, or maybe you should focus on other areas that are lower risk. That's really a personal decision, but you need to be very comfortable with that. And third, focus on properties that are going to give you both capital growth and rental growth. You want both, because only then will each property be a stepping stone to the next property. Because look, buying an investment property, that's great, but one property in and of itself is not going to get you to where you want to go. Sure, it's better than having none, but really property investing is not a one-off event. It's a process that you need to go through over a number of years. And a big part of that process is to focus on properties that give you both capital growth and rental growth. And look, if you want a deeper dive into how do you actually do that, check out the link in the description below to get totally free the audio version and digital version of my book, Wake Up Wealthier: How to Build a Passive Income Through Property, even if you've never invested before. It's a total property investing roadmap based on my now 23 years of investing experience. It contains the very same strategies that we've now helped over 500 investors invest successfully in property. But now let's take a deeper dive into the exact steps and strategies you need to use to achieve your property investing goals. Step 1, focus on capital growth first, not positive cash flow. Look, I see so many investors chasing higher yielding properties. They want that positive cash flow, but really that's not what they want. What they're really after is capital growth. What they're hoping for is they buy that property for say 700 grand and it's going to be worth over $1 million in a few years. But while they hold the property, they don't want the property to cost them any money. They want the property to actually give them an income. It's the holy nirvana that I see so many others on this platform and others talk about. But look, here's the truth. In Australia, property investing has always been a capital growth game. Yes, I understand that there was a time when the Perth market was giving you capital growth and positive cash flow, primarily because it was a market that hadn't grown for 11 years or so, and interest rates were at record lows. The RBA's rate was at 0.1% just after the pandemic. Now, that's sort of a once-in-a-lifetime opportunity. Many people got lucky with that, but that's not something that's going to happen all the time. Right now, with where interest rates are, yes, they're falling, but it's more than likely that any property you buy that's in a quality area, it is going to be somewhat negatively cash flowed. So what you want to focus though on is making sure that this is a property that is in a location that's likely to rise in value, so you will get capital growth, but also where there's stronger rental demand than available properties for rent, so that your property will get rented out quickly, and where your rents are likely to rise as well, which will improve your cash flow over time. Because here's the thing, it's capital growth that will build your wealth. You want to buy properties, like I said, for say $700,000 today that are likely to be worth over $1 million in the coming few years. That will give you an increase in equity, which you can then pull out if you're buying property, say in your personal name, to then buy other properties down the track. Or if you're buying property in your super fund, you still want properties that are going to rise in value so that at some point in the future, you can sell and realize the cash. Just make sure you do your cash flow numbers so that any negative cash flow on the property doesn't affect your lifestyle. And that brings us to step 2, which is your goal. Now, what I'm about to say will almost certainly be very different to what you're hearing out there. And here's what I mean by that. Many people will say, set a goal of how much passive income you want every single month. Now, while that's great, that can actually mislead you. Instead, you want to be focusing on building a large enough debt-free portfolio. And it's what most people get wrong. They focus on the short-term monthly returns. Like I said earlier on, they're looking for high-yielding properties. They're looking to buy in areas where perhaps the capital growth foundations aren't that strong, but they're drawn by the attraction of positive cash flow and high income returns. But that can totally take you away from what you're actually trying to achieve, which is true lasting wealth for yourself and your family. Because the true power in property investing comes from owning high quality, debt-free assets that can provide you a long-term income. So how do you actually have a property with no debt when the average property price is $1 million and most people can't afford to buy a property with no debt at this stage? Well, I'll come to that in just a moment. But the key takeaway from just this part is this. I want you to reframe the way you look at property investing to instead say, how can I own as many high quality properties as I can debt free? Now, the way to do that though is again going to be quite counterintuitive. And that brings us to step 3 in this process, which is you first want to use debt. You want to leverage wisely, and then you deleverage strategically. What do I mean by this? Well, most people are conditioned from a young age to have a fear of debt. They are told debt is bad. And so what happens? They are first of all very hesitant to buy an investment property. So they kind of sit on the sidelines for many years and then wait and see how much prices have risen, and they miss out on the opportunity. And then when they do get in, they're still extremely cautious. They might buy, say, one investment property, and then they try to pay it off because that's what they've been told to do. Pay off debt as fast as you can, get your income from your job, and use as much of that to pay off the debt. The problem with that is, while it might have worked 10, 20, 30 years ago, that advice is no longer valid today. How many people can afford to pay off multiple properties with an average price of $1 million? It's just not feasible. But that's the approach people take because they don't know any different. Instead, you do not try to pay off an investment property with your income. That's not what you do. Instead, you simply hold on to the property, have it rise in value, and when it does, you actually take on more debt. You use the equity from that property to buy a second property, and you keep buying as many properties as you can reasonably afford, focusing on strong capital growth fundamentals without compromising too heavily on cash flow, which might then negatively affect your lifestyle. Now, that might mean that you buy, say, a property now, and then you might buy another property in 3 years' time, and maybe one 3 years after that. That's okay. It's not about necessarily buying one property every single year. Rather, it's about being very strategic and growing your portfolio at a pace that you're comfortable with and not affecting your lifestyle. Now, notice what I just said. The focus is about growing your portfolio without affecting your lifestyle. So I'm not saying you should be irresponsible with debt and go and leverage yourself to the hilt and then live on bread and water while this portfolio is growing in value. But at the same time, I did not say you should focus on paying off the debt prematurely, because that's what a lot of people I see do. They focus on paying off the debt, and as a result, they actually miss out on other investment opportunities. So let me be clear. You buy a property, it rises in value. You take out the equity, you can go and buy another property. You rinse and repeat. Now, from a cash flow perspective, you're probably wondering, well, if each property is negatively cash flowed, and let's just say it's negatively cash flowed by $1,500 a month, how many of those properties can somebody own? Because let's say you have 3 properties, each one negatively cash flowed by $1,500. That means now you have a negative cash flow each month of $4,500, doesn't it? Well, that's what most people think, and that's where they actually get it wrong. That should not be the way you do it. Instead, remember what I said earlier on, you're focusing on properties that give you both capital growth and rental growth. So for example, you might have a property on day one that does cost you about $1,500 per month. And I'm talking about before tax. I'm not talking about any tax rebates because of course, I don't know what your income is and what your tax rate you're on. So before tax, all right, this property might cost you $1,500 a month. But over time, that $1,500 a month gap will reduce, especially with where we are in the interest rate cycle. Interest rates are falling, so therefore your expenses will reduce, which will reduce that gap. Secondly, if you buy in the right areas where property prices are rising, but rents are rising, your income will also increase, which will further reduce that gap. So then maybe over a short amount of time, you might end up in a situation where that $1,500 a month ends up being $500 a month. And then you might be able to go and get another property that might cost you this time $1,000 a month in negative cash flow because interest rates have fallen. So now you have two properties. Property one is costing you $500 a month because the interest rates have fallen and rents have risen. And second property is now costing you $1,000 a month. So 500 plus 1,000, that's $1,500 per month. So you now have two properties that are costing you the same from a cash flow perspective as the first property you bought. Now what do? You rinse and repeat. You wait until you have the equity build up and the cash flow is back to a level that's affordable for you, and then you go and buy a third property. Following this process is what's helped us help so many clients build portfolios of now 4, 5, and one has even got 7 or 8 properties. They're actually about to buy their 8th property, and yet their cash flow is still about the same as what it was when they had one property. That's the beauty of following this strategy correctly. Your cash flow position stays roughly the same while you build out that property portfolio. So we do not want to be hurting your cash flow and your lifestyle on a month-to-month basis. Now, of course, if you are someone who is an aggressive saver, you have a higher income, maybe you have already paid off some debts, and maybe you have, say, $3,000 a month spare per month, you might be in a position where you could very quickly go and buy 2 investment properties, each one costing you $1,500 a month. And obviously that will help you build your portfolio more quickly and will help you get to your property investing goals more quickly. Absolutely. So this all comes down to your personal situation and where you're starting from. But the plan still works. It just needs to be tweaked to your personal circumstances. But remember this, if you have a time frame of, say, trying to retire in maybe 10 years or 15 years, you don't have 10 years, 15 years to buy property. You want to buy as many properties as you can as early as possible so you have time on your side. You have years for the properties to grow in value. That's the important part, is you want to be in the market for as long as possible. And then what are you going to do? You are going to do some kind of strategic sell-off. Yes, I know that there's lots of people out there who will say you should buy the best properties you can and never, ever, ever sell. That's fantastic. And that might have worked again 30 years ago. But if you're serious about building true wealth that's going to last, you have to be willing to look at potentially selling properties down the track. Now, how do you decide? Well, that's going to come down to a case-by-case scenario, but let me give you an example. Let's say, for example, you bought 2 properties, each at, say, $1 million. Over time, they have risen in value. Each now is worth $2 million. Okay? You've still got a fair bit of debt on both properties. What could you do? Well, you could, for example, sell that second property, pay the capital gains on the profit, but still whatever's left, use that to then pay off the debt on this first property. And now you have a property that's potentially worth $2 million that's debt free. And if it's giving you, say, a 5% rental return at that time, it's giving you 5% of 2 million, $100,000 in gross income. Now, of course, you still need to pay your property management fees, your rates and everything else, but that's true passive income. And you've built an income of around about $100,000 per annum in just this hypothetical example without chasing yield play somewhere in small country towns. You've done it by focusing on true fundamental wealth building. This is not a get-rich-quick scheme. This is a get-rich-safe system that I'm sharing with you. It does require due diligence, it requires care, it requires the right strategy. But done correctly and given enough time, you can realize some true wealth by simply buying property in a very safe manner with the right guidance so that you don't get this wrong. Because when you get it wrong in property investing, it's not something you realize tomorrow. I'm sure you know the property market. It's not liquid like the share market where you can buy today and sell tomorrow. You often don't realize the consequences of your mistake for many months, if not even years later. And what happens then is even if you can sell the property and get your money back, that's nice, but what have you lost? You've lost time, and that's something you can never get back. But more importantly, the opportunity cost, right, of buying in the wrong area when you could have bought somewhere else and made hundreds of thousands of dollars in capital gain. So this is something that is going to take a lot of care, but done correctly. We've helped countless clients on this path. Many of them are at the end of their journey here, and they have true wealth that they can even pass on to their kids if that's what they choose. So ultimately, this brings us to step 4 of this now 5-step process, which is make your decisions on data. Take out the emotion from the process. It's not about the properties that you like, that you might want to live in. That's not necessarily what's going to work for you. One of my clients at the time were a young couple. They were dual income, no kids, very lifestyle driven. They loved to travel. They didn't really want properties with a lot of maintenance. So they were living in a 2-bedroom unit in Melbourne, which they absolutely loved. They loved the lifestyle. They loved the proximity to the cafes. But when they started on their property investing journey with us, and we started showing them 4-bedroom properties in suburbia, the wife especially, she freaked out. She said, who's going to live in these properties? Now, that might sound crazy to you, especially if you're someone who lives in a freestanding house. But for her, it was almost unimaginable that someone would want to live in these kind of properties, because that was not what she did. That was not what any of her friends did. That was not what her sister did. And so for her, she thought that because everyone she knew lived in apartments and they loved the cafe lifestyle, that's what she should buy. And it was only once we went through the data and shared with her the facts and figures and how house prices have grown far more than apartment prices in the right areas that she could see that she could not make her investing decision based on her own personal biases, her own personal emotion, what her friends and family were doing. No, she had to focus on data. Today, she and her husband now have 3 investment properties that have all grown significantly. Rents have risen. Their cash flow is improving over time, and they're looking to continually build their portfolio. So I hope this shows you that what you think might be a great property to live in, because that's what you would want, doesn't necessarily mean it's the right investment. Ultimately, remember, when you're buying an investment property, you're looking for the best return on your money. You're looking to say, where can you invest a certain amount of money, whether it's 150, 200 grand worth of cash or equity, and get the maximum return on that over time. And when I mean return, I'm talking about the maximum growth on that property, on that money, so that then you can potentially use that property and the growth in that property to buy further properties and keep building your wealth. This is a wealth building system that we're talking about. We want to remove all emotion. And that also means that we avoid the hype. We want to avoid any investor hotspots, markets where the majority of people buying are investors, markets where the majority of people living there are tenants. These are high risk markets, markets that have been sold to investors chasing the dream, like the person I mentioned at the very start of this episode. And these are markets where, when most people living there are tenants, they're living there temporarily, probably because there is a number of projects happening there for temporary work. But once those projects finish up, once the jobs dry up, your tenants leave, those properties sit there like a white elephant, unable to get a tenant, probably unable to sell because there's no one who actually wants to live in those areas. So don't chase emotion, focus instead on data. And as an investor, if you want to focus on anything, focus on owner-occupier hotspots, where people are actually moving to live long-term, where demand from people who want to live in that area, and I mean people want to buy homes to live in that area, is higher than the supply of available properties. I've seen too many investors get burnt by buying in mining heavy towns or seasonal tourist spots because they love the fact that the property was close to the beach. Instead, focus on your fundamentals, strong jobs growth, strong economic diversity. Like I've said a couple of times, strong demand from owner-occupiers. That's what's going to help you reach your property investing goals. And when you're choosing the right properties to buy, you don't want to be buying properties necessarily that you might like. Instead, you want to focus on what people who are buying properties in that area, what do they want? And base your decisions on data. And look, if this can sometimes feel a little overwhelming, feel a little complicated, if you're worried that you might not get this right and that could cost you a lot, our team can take the stress away from you. So if you'd like to find out more about how we could potentially help you get the right property in the right location, where you're going to get capital growth, where you're going to get rental growth, and where you can use that property as a stepping stone to future properties, in the description below, there'll be a link for you to book a completely free, no obligation consult with a member of my team to find out more about what we do and see if what we do could help you, like we've helped so many others, build a property portfolio without you virtually needing to even leave the comfort of your own home. And finally, this brings us to step 5 that I alluded to earlier on. This is not a get rich quick plan. This is a get rich safe plan. Always take into account your risk tolerance. Have a look at every property investing decision you're making. What so many people get wrong is they try to push the boundary. They almost try to redline it. And what I mean by that is they take on investments that are really risky for them. They try to perhaps do a quick property buy, renovate, and flip, yet they live in Perth and they try to do the deal in Brisbane. They don't know anybody there, but someone's told them that's a good idea and they can make a large amount of money in a short time. And they sort of approach that with kind of, dollar signs in their eyes, and they're not looking at the risks. They're not doing their due diligence. They don't have the right network of people, and their investments end up going pear-shaped. This is not about trying to make a quick gain just to catch up on time. This is about a process that can work for you when done correctly. So if you were looking for something that's going to help you get rich quick, sorry, I probably wasted your time here. This episode is not for you, and I would say that property investing in general might not be for you. The best way that I know to invest in property is through a disciplined, consistent approach where you focus on properties that are very much what I like to call set and forget type properties. Properties that don't give you any maintenance hassles or very few, properties that get rented out very, very quickly, and properties that are in areas that are likely to grow consistently, outperforming the national average, so you can keep tapping into that equity and keep buying another property, rinsing and repeating the process at a frequency that you are most comfortable with. And here's the best part. Done correctly, you might only need 3, 4, maybe 5 properties initially. You might then sell down a couple of them, and you can very easily end up with 2 or 3 properties totally debt-free, be a property net multi-millionaire with a passive income coming in that's 6 figures or more every year. And yet you have taken very few risks. You've done this very safely by following the right approach. Look, these 5 simple steps will help you invest in property safely and successfully. I've helped so many people do this that I know this process works. But from here on in, if you then want to work out, okay, well now how do I then build a monthly income? Check out this next video where I share with you my 10 steps on how to build an income of $10,000 per month through property.